It's 9:47 on a Wednesday morning, and you're sitting in a beige conference room that smells faintly of burnt coffee and regret. The fluorescent lights are doing that flicker thing they always do. Someone from HR, let's call her Jessica, is standing at the front of the room with a PowerPoint that has way too many bullet points and a stock photo of a couple in their 60s smiling on a beach, both of them holding champagne glasses like they just cracked the code to life. And Jessica is talking about your company's 401k plan. She's saying words like pre-tax contributions and employer match and compound interest. And you're nodding along because you know you're supposed to care about this. You know this is the responsible adult thing to do. But honestly, you're mostly thinking about lunch, or that email you need to send, or literally anything other than what's happening on slide 17 of this presentation. But then Jessica says something that snaps you back into the room. If you're not contributing to your 401k, you're leaving free money on the table. Free money. And suddenly, you're paying attention. Because who doesn't want free money? You've got student loans, you've got rent, you've got a car that's making a noise it shouldn't be making. Free money sounds great. So you sign up, you fill out the forms, you pick some funds with names you don't really understand, something about growth and index and 2055, and you set your contribution to whatever percentage gets you that full employer match. Maybe it's 3%, maybe it's 6%. Whatever the number is, you do it. And then you don't think about it again. For years. Because that's what you're supposed to do, right? Set it and forget it. Let it grow. Let compound interest do its magic. Retire at 65 with enough money to finally take that trip to Italy you've been talking about since college. Except, here's the part nobody mentioned in that beige conference room. What if the entire system, the 401k, the employer match, the tax advantages, all of it, what if it was never actually designed to help you? What if it was designed to help someone else entirely? And what if, by the time you figure that out, you've spent decades funneling your money into a system that's quietly, systematically working against you? Stick with me, because what I'm about to show you will completely change the way you think about retirement, corporate benefits, and who's really winning in this game. Here's what most people believe about 401k plans. They're a gift, a benefit, a cornerstone of responsible financial planning. You contribute, your employer matches, the money grows tax-free until retirement. It's a win-win. And if you've ever felt guilty for not maxing out your contributions, or if you've ever looked at that balance and thought, this is my golden ticket to retirement, you're not alone. That's what we've been told. That's what the financial system wants you to believe. But here's the thing most people don't know. And this is where the story gets interesting. The 401k wasn't created to make your retirement better. It was created by accident. In 1978, Congress passed a tax code revision, Section 401k, that was meant to give executives a tax break on deferred bonuses. That's it. It was a loophole for rich people to shelter income. But in 1980, a benefits consultant named Ted Benna realized you could twist that loophole into something else, a way for companies to offload the responsibility and the cost of retirement planning onto their employees. Before the 401k, most big companies offered pensions. A pension meant the company was on the hook. They managed the risk. They guaranteed you a paycheck for life after you retired. It was their problem, not yours. But the 401k flipped the script. Suddenly, you were responsible for picking the funds. You were absorbing the market risk. You were the one who had to figure out if you were saving enough. And the company? They just had to kick in a match, which, let's be honest, is way cheaper than funding a full pension. By the mid-1990s, pensions were basically extinct, and the 401k became the default. So here's the thesis, and I need you to sit with this for a second. The 401k isn't a retirement plan. It's a cost-shifting strategy that transferred financial risk from corporations to you while making you feel like you were getting a benefit. You might think your 401k is working for you, but the truth is, it's working on you. And the people who designed the system knew exactly what they were doing. Let's break this down piece by piece, because this isn't about demonizing 401k plans. It's about understanding what you're actually dealing with. And once you see it, you can't unsee it. Layer 1, the free money trap. Let's start with the employer match, because that's the big selling point, right? We'll match 50% of your contributions up to 6% of your salary. It's free money. Okay, let's do the math. Say you make $60,000 a year. You contribute 6%. That's $3,600. Your employer matches half of that, $1,800. So you're putting in $3,600 and they're putting in $1,800. Total, $5,400 going into your 401k every year. Now, on the surface, that sounds great. But here's what nobody tells you. That $1,800 match, it's not a gift. It's part of your total compensation package. When companies budget for employees, they're already accounting for benefits, health insurance, 401k match, all of it. That money was always part of what they were willing to pay you. They're just giving it to you in a form that locks it up until you're 59 and a half, penalizes you if you touch it early, and forces you to navigate a system most people don't fully understand. And here's the kicker. If you leave the company before you're fully vested, which depending on the vesting schedule can take anywhere from 3 to 6 years, you don't even get to keep the full match. You forfeit it. So it's not free money, it's conditional money. And the conditions are designed to keep you working for that company longer than you might want to. Layer 2, the fee monster. Now let's talk about fees, because this is where the 401k industry makes an obscene amount of money off your back, and most people have no idea it's even happening. Your 401k isn't just sitting in a vault somewhere growing, it's being managed, and management costs money. There are fund expense ratios, administrative fees, record-keeping fees, sometimes even fees just for having the account open. Here's a real example. Let's say you have a 401k with an average expense ratio of 1%. That might sound small, 1%, whatever, right? Wrong. Let's say you contribute that same $5,400 per year, $3,600 from you, $1,800 from your employer, and you do that for 30 years. Assume a 7% average annual return, which is pretty standard for a diversified portfolio. With no fees, after 30 years, you'd have about $540,000. But with a 1% annual fee, you'd have about $412,000. That's a difference of $128,000, over $100,000, gone. Not because you made bad investment choices, not because the market crashed, just because of fees. And here's the thing that makes this even worse. Most people have no idea what fees they're paying. A 2019 study found that 37% of 401k participants thought their plan had no fees at all. Not low fees, no fees. They're paying them. They just don't see them because the fees are baked into the fund performance. They're invisible, and invisibility is very profitable. Layer 3, the illusion of choice. Now let's talk about the funds you're allowed to invest in. When you sign up for a 401k, you get a menu of options, maybe 10 funds, maybe 20, and they all have names that sound vaguely the same: Large Cap Growth Fund, International Equity Fund, Bond Index Fund. But here's what you don't get: actual choice. You can't buy individual stocks. You can't invest in real estate. You can't put money into a side business or a startup or anything outside that pre-approved menu. You're locked in to whatever your employer's plan administrator decided to offer. And who decides what goes on that menu? Not you, not even your employer usually. It's the plan administrator, companies like Fidelity, Vanguard, or a dozen others. And sometimes the funds on that menu aren't the best performing funds. They're the ones that pay the highest fees to the plan administrator. There's a term for this. It's called revenue sharing. And it means the companies managing your 401k have a financial incentive to steer you towards funds that make them more money, not funds that make you more money. You might be thinking, okay, but isn't this illegal?
And the answer is technically no, because it's all disclosed, somewhere, in a document you probably never read, in language designed to be as incomprehensible as possible. Layer 4, the tax time bomb. Let's talk about taxes, because this is the part that really flips the script. The big pitch for 401k plans is that they're tax-advantaged. You contribute pre-tax dollars, which lowers your taxable income now, the money grows tax-free, and then you pay taxes when you withdraw it in retirement. Sounds good, right? Except, here's the assumption baked into that pitch, that you'll be in a lower tax bracket when you retire. But what if you're not? Think about it. If you do everything right, if you save diligently, if your investments grow, if you build up a healthy 401k balance, you might actually be in a higher tax bracket in retirement, especially if tax rates go up between now and then, which historically they tend to do. And here's the part that nobody warns you about. Once you hit age 73, the IRS forces you to start taking money out. They're called required minimum distributions, or RMDs. Whether you need the money or not, you have to withdraw it, and you have to pay taxes on it. So the government is essentially saying, you've been deferring taxes for 30 years. Cool. Now we're going to force you to realize that income, and we're going to tax it at whatever rate we want. You thought you were getting a tax break, but really you were just deferring the bill, and when it comes due, you have no control over the rate.
So why do we fall for this? Why do millions of people sign up for 401ks without questioning the structure, the fees, the limitations, or the long-term implications? Because of something psychologists call default bias. When something is presented as the default option, the normal thing to do, most people just do it, no questions asked. The 401k is the default retirement plan in America. It's what your employer offers. It's what your parents probably used. It's what every personal finance blog tells you to max out. So you do it, because not doing it feels risky. It feels irresponsible. But here's the thing about defaults. They're set by whoever has the power. And in this case, the people who set the default are the same people who benefit from you staying inside the system. There's also loss aversion, the idea of leaving free money on the table, the employer match, triggers a fear of missing out. You don't want to lose that match, so you contribute, even if the long-term cost of fees, tax implications, and lost opportunity might actually outweigh the benefit. The system is designed to make you feel like opting out is the risky move, but opting out might actually be the smarter play. All right. So what do you actually do with all of this? Because I'm not saying never use a 401k. What I'm saying is understand what you're getting into and don't let it be your only plan. Here's the framework. Step 1. Contribute enough to get the full employer match, but stop there. Yes, take the match. It's still better than nothing, but don't feel obligated to max out your contributions just because some financial guru said so. That match is the only part of the 401k that's genuinely in your favor. Beyond that, you're just feeding the fee machine. Step 2. Open a Roth IRA. Unlike a 401k, a Roth IRA lets you contribute after-tax dollars and then the money grows tax-free forever. No taxes when you withdraw, no RMDs. You control the account, you pick the investments. No employer, no plan administrator, just you. In 2026, you can contribute up to $7,000 per year to a Roth IRA if you're under 50. That's not going to replace a 401k, but it's a hell of a supplement, and the tax advantages are way better if you expect to be in a higher tax bracket later. Step 3. Diversify outside of retirement accounts. Invest in a taxable brokerage account. Buy index funds, invest in real estate, start a side business, build assets that aren't locked up until you're 60. The 401k traps your money for decades, and life doesn't wait for retirement. You might want to retire early. You might want to take a sabbatical. You might want to start a business in your 40s. If all your money is in a 401k, you're stuck. Step 4. Audit your 401k fees.
Log into your account, find the fee disclosure document, look at the expense ratios on every fund you're invested in. If they're over 0.5%, you're getting fleeced. If your plan offers low-cost index funds, switch to those. If it doesn't, that's a red flag. Step 5. Think of retirement as a strategy, not a product. The 401k is a product. It's something sold to you, but retirement is a strategy. It's about building enough wealth and freedom that you can live life on your terms, whether that's at 50, 60, or 70. Don't let a corporate benefits package dictate your entire financial future.
If this video just flipped a switch in your brain, if you're sitting there thinking, wait, I've been doing this wrong. Good. That's the point. The system isn't going to tell you this. Your employer isn't going to tell you this. But now you know. Share this with someone who's been blindly maxing out their 401k without asking questions. Drop a comment and tell me, are you still going all in on your 401k, or are you shifting strategy? Because I want to hear how you're thinking about this. And if you want to keep pulling back the curtain on the financial system, subscribe. There's a lot more where this came from.